a comprehensive look at trends, fund profiles, and more in Exploring ETFs.
Hi everyone, welcome to Exploring ETFs. I'm Neena Mishra, and today we are talking about energy ETFs, oil and gas ETFs. And we know that oil prices have been surging over the past few weeks, and that is mainly due to supply disruptions and rising demand. And in fact, Brent crude prices topped $85 per barrel recently, and this is for the first time since late 2014 that prices have seen those levels. And according to a recent article in the Wall Street Journal, many traders are now betting that US oil would cross $100 per barrel by the end of this year. So there's a lot of option activities in the space that also may be leading to this surge in oil prices to a certain extent. Now, we know that demand for oil has been rising because global economies are reopening after many months of pandemic-driven lockdowns. And according to the International Energy Agency, demand will continue to rise at least through 2026. And on the supply side, we know that investments in oil and gas have been declining because governments and investors, particularly institutional investors, now prefer a transition to green energy, clean energy. And in fact, many institutional investors have pressured companies like Pioneer Natural Resources, Occidental Petroleum to curtail their spending, and they should return their money to shareholders. And production cuts by the OPEC, they have also boosted oil prices, and while OPEC and its allies, they will raise production in the coming months, the output is likely to stay below rising demand. And we know that transition to green energy and electric vehicle is still many years away. Natural gas prices have been on a wild ride, particularly in Europe, because declining investments, they have left the continent heavily dependent on Russia for imports of natural gas. In fact, prices have surged to almost 10 times their level from the start of the year last week, but then the reverse course after Russian President Putin said that Moscow was a reliable supplier. This insane surge in natural gas prices have resulted in use of oil as an alternative in some power plants, and that could additionally boost the demand for oil in the longer term. Now, if you want to invest in oil and gas, there are many ETFs which use futures to track the price of commodity. Those ETFs, they track the prices well in the shorter term, but they are not for longer term holding, because in the long term their performance can differ a lot due to contango issue, because they need to continuously roll over those futures. For longer term investors, it is better to invest in oil and gas ETFs that invest in companies, energy companies, that are stable and driven mainly by fundamentals. Now, let's take a look at 3 different types of energy ETFs that have been doing quite well lately. So the first one I'm highlighting is the largest, most popular, and one of the cheapest energy ETF. It has over 23 billion in assets and charges just 12 basis points and provides comprehensive exposure to the entire energy space, but it is market cap weighted, so it will be top heavy. Let's take a look at this ETF. By going to the code page on Zacks.com, you can read our research report and articles, and then using the link, you can go to State Street webpage for this ETF, and you can learn more and also look at the holdings. So as I mentioned, it is market cap weighted. So biggest players in this space, Exxon and Chevron, they account for more than 40% of the portfolio. And then there are other players like Schlumberger, ConocoPhillips, EOG Resources, etc. The second one that I'm highlighting is also by State Street, but it is quite different because it is equally weighted. So if you're concerned about top heavy exposure of the earlier ETF XLE, then you can look at XOP. This focuses on E&P companies and uses equal weighting scheme. And because of that, it is slightly more expensive, 35 basis points. And this is also very popular with about 4.5 billion in assets. Again, to learn more, you can go to the code page and from there, the external home page, and look at what it holds and also the actual holdings. So you will see all those E&P companies, but they are always equally weighted at the time of rebalancing. That is the difference in the ETF. Now the third one I'm highlighting is again very different. This is actually one of the top performers over the past year, so I decided to include this. This actually uses a price momentum weighting scheme. So companies are selected and weighted by their price performance. The companies that see the best price performance, that they get higher weighting in the ETF. The ticker symbol is PXI, and because of this niche exposure and weighting, it is expensive, 60 basis points, and it is also relatively much smaller with 93 million in assets. Again, to learn more, you can go to the code page and from there, the external home page, and see what it holds. So you will see it has a lot of exposure to small companies. So it is going to be volatile. It will do very well when smaller companies and mid-sized companies do well, but in general, it will be volatile. So looking at the holdings, not very recognizable companies that have done very well, Range Resources, etc., Continental Resources, Valero, Devon, these are among the top holdings in the ETF. On the last slide, I have the price performance of these three ETFs versus the S&P 500 index. So the first one, the Investco product, the third one that we highlighted, is up more than 155% over the past year. The equal weighted product, XOP, is up more than 145%, and XLE has almost doubled over the past year, whereas the S&P 500 index is up about 30% over the past year. Thanks for watching. Make sure to check out zacks.com/promo for an interesting offer, and also make sure to subscribe to our videos, our video channel, so that you do not miss anything. And I will see you next week.